So a lot of reaction and thoughts here, guys, to what could happen if the U.S. goes this route in terms of trying to clamp down on investment into China.
I'm inclined to channel my inner Jim Cramer and kind of just lose my mind on the set, because this is something that, to the extent I have hair left to pull out, is so complex. I mean, can you have an executive order that mandates the SEC stop trading in all Chinese listed shares?
There's a will, there's a way. I mean,
absolutely. But the amount of chaos that would be created by doing something like that is relatively ill-conceived, not terribly well thought out in many different ways, would have the knock-on effects would be extraordinarily large.
If you're an investor in one of these Chinese companies, you've lost money, it's a fraud, you have no recourse, basically.
Understood, yes.
So understanding that with a lot of other jurisdictions, they list their shares here because presumably there's a way to still use their rule of law to go after companies that are fraudulent. If that's not the case with China and you have investors losing money in all of these companies, and what's the U.S. supposed to do? But that's not the argument. This is trade retaliation. So if you want to address that, that should come up in these bilateral negotiations with China about accounting standards. I mean, Europe has different accounting standards than the U.S. So does as Bob said, so does every other country on the planet. So listing them has been a process whereby we've overlooked a lot of that for the last 10 or 20 years. So reconciling that as part of the trade process is different than coming out and saying, OK, this is a legitimate investor issue, however they want to frame it.
So I'd add two more points to what Ron already said. I said, first, we knew that this sort of path was possible back when the negotiations came to a halt in May. And China said the U.S. is trying to make us change our law. So that's a step too far into our sovereignty. And this is sort of, in my mind, the same path. China has to adopt certain America's standards, and maybe they should. But being forced to do that, I think, is something that could be a threat to the trade negotiations. Maybe it's smart leverage, but I think it's something that should be reflected in the markets.
Like being told.
No, but the second point on all this is I think as investors, we have to make sure we're doing a lot of stress testing, scenario analysis, because this isn't the only one out there. So you have the Rubio bill. By the way, bipartisan support doesn't go away despite what party's in power. There's another one, Baldwin-Hawley, that got introduced recently. That would tax any foreign capital, not just Chinese capital, coming into the U.S. as a way to weaken the dollar and to try to balance our balance of payments.
It would tax any capital flows?
But it would be variable. So somehow this would be a new Fed mandate that somehow the Fed would know how much tax to levy to manage capital inflows and outflows.
That sounds complex.
I mean, they're the ones who keep track of FDI, right?
It seems very difficult to see either of these bills, in my mind, get passed. But if they get support from the president and there's momentum behind them, they absolutely can affect the markets, especially as we go into election year. The third leg of this that I'm just thinking more and more about, even though, again, very low probability, President Trump clearly wants a weaker dollar. He clearly wants to balance trade. He can intervene. He can tell the Treasury, you must intervene. And even though the Treasury capital to do so would be very, very limited,
it was about $50 billion.
The symbolic act would be huge. And then does the Fed, usually, historically, the Fed supports such intervention. Would they go along?
But if they limit dollars leaving the country, that's going to make a stronger dollar, not a weaker one.
I totally agree with you.
Right, and then they have to sell dollars from the Treasury's Exchange Stabilization Fund. Again, those dollars are limited. They can instruct the Federal Reserve to cooperate, but in the way the Federal Reserve has cooperated in the past was by further lowering interest rates in conjunction with dollar sales. So it's such a complex problem when you start getting down to this level of granularity. The unintended consequences could be extraordinarily large.
To me, that's the big picture takeaway. If we thought the tweets and the changes in policy around trade created uncertainty and weighed on company decision-making and corporate spending, this is just more of that. And even if we have a trade deal, well, then maybe we have a capital war. So our businesses, even if we have a trade deal, going to say, great, home free, we have clarity, let's invest. Or are they going to say, we don't know what the rules of the road are still?
And the casualties of capital war would be the same casualties of a trade war. I mean, in today's session, on the back of this headline, we're seeing sort of these poster children of trade, the semiconductors. You know, these are the kinds of stocks that took another leg down and are still at session lows. So when you go down the road and think about how China can actually retaliate against us, it is by making it very difficult for U.S. companies to do business in China.
Absolutely.
I would be worried about that in terms of
they in turn, although they've reduced their direct investment in the United States pretty dramatically of late, whether it's in real estate, whether it's in manufacturing, you know, they do still have a stockpile of bonds. I don't think that's as big a problem as I once thought, but they too can devalue their currency.
Well, they did today, not devalued it. I don't want to overstate it, but the dollar definitely appreciated against the renminbi today, which is not a shock given this news. And they're going to use that to help support their exports, and it's going to push up the dollar. You have to remember, too, the renminbi has a basket of currencies it trades against. So when the renminbi moves, there is a strong correlation between what happens with renminbi, what happens with other Asian currencies, commodity currencies, even the euro. So the result of all this is a stronger dollar, and that goes against what this administration is trying to achieve.
And the worrisome part is it does not appear that we have anybody who really understands fully the consequences of these actions that they've taken so far step by step. They could easily send us into a situation, and it's happened in the past with poor policies. In the 70s, you can go back and look at some of the big mistakes that were made by Treasury, by the Fed, and that has large-scale economic repercussions.
This is still more symbolic. I mean, $1 trillion worth of market cap, limiting the U.S. government pension fund investment in China. These are not the major sources of cross-border flows. It seems more symbolic. It seems to be more a trade war posturing, as you're suggesting, than necessarily a permanent sea change.
And also, what kind of message are you sending if you're saying, you know what, we're going to pick on Chinese stocks and delist them? That can happen to any other sorts of stocks in the world.
This is sort of, and people have talked about this in a certain fashion. The sort of mob element of it is, listen, you don't play nice with us, we're not going to play nice with you. And people get that message. It's not just directed at China. That will come up in other situations.